Hello, friends. Welcome to this special episode of Weekend Investing. We try to do some data analysis and analytics on past data available on stocks and different metrics and try to derive insights from them and see how it impacts investor behavior and how we can improve our thought process in approaching the market. So, like you must have heard this before that, stock XYZ, profit after tax growth has been super robust. So it's a great pick. You can buy and forget the stock. But does it really happen like that in real life? Sometimes you will see, stocks delivering great results and, stock prices are surging. For instance, this case, or there may be other cases where, great growth in profit after tax, but shares are falling. So let's take examples, LTIM in this case, that there was a fantastic move in profits in FY 21-22. Profits grew from 800 crores to 3900 crores over the last 5-6 years, and the stock also was performing fantastic. And when the final results around March 22 were released, earnings were robust. Stock performance of the last many years was fantastic. So naturally, those who have not had a ride on this stock would be very, very attracted to this stock. That this company continues to power ahead in terms of its earnings and the stock performance. So it should be bought here. There is no risk of any kind. And then if you did enter the stock at that point of time, you had a 50% drawdown within 3 months, despite profits going up. And essentially it took a long consolidation post that. So 3 years there has been no return on that stock. So how do you sort of come around to justify this? So stock prices in effect are reflecting future growth and the market expectations. The current profits that we get, let's say we get a 3 month uh, quarterly result or an annual result, in my view, that is the result of the past. It's like rear view mirror driving. You don't drive your car looking at the rear view. If the road has been good so far, does it really say that the road is great for the rest of the journey also? It doesn't, right? I mean, you had a great ride so far and you are now at point B. Now you have to go to point C. B to C may not be as good as what you've witnessed A to B. And so you can't really say that A to B was great and hence, I'll double up at B and we'll go further. So while we had a great ride in 5 years, almost 1150% in that time period, but a lot of folks probably enter towards this part of the rally once they are fully convinced that every year on year on year on year, earnings is growing, there is a pattern, there is consistent management talk, there is earnings growth, there is price growth, and there comes a point of time where you are fully convinced that nothing can go wrong in this company and it will keep churning earnings like it has been doing, and the stock price will go to the moon. And that's exactly where some brakes are applied. I'm not saying for even 1 second that this stock will not go up eventually. It may go up, but there is a process in terms of identifying stocks that are in trend and then getting out if that those trends are not going your way. So no performance, but profit after tax has still doubled in the 3 years. So essentially price is doing a time correction and earnings are catching up, and the expanded price earnings ratio is sort of normalizing to some extent right here. Another case could be Kotak Bank, where we've had almost 4.5 years of no stock price performance right now, but the bank has been growing, the PAT has been growing. So people keep seeing that the PAT has gone from 7,200 crores to almost 18,000 crores in the last 4 or 5 years, but the stock price has not moved. So the intelligence of the market at in these years, they have already discounted what is coming here. So instead of looking behind, people are looking forward, and market is always forward looking, trying to guess what will happen to this company in 2, 3, 4, 5, 10 years and pricing it accordingly. So you can't get the stock at today's uh, past valuation or earnings. You are already discounting much farther ahead, and that is the mismatch that happens usually, is that market is expecting so much, but the company is delivering less, then stock prices will crash. If the market is expecting here and the performance is here, then stock prices will rise. So it is all about expectation management, and for an investor to guess or to calculate where is that expected point right now in terms of this stock. So I know the trajectory of earnings of Kotak Bank. I know everything about Kotak Bank, let's say. But then the current price, what is it discounting? Are we discounting to 2030 earnings? So there may be a case that you get in today until 2030, there are no gains. There may be a case. So it all depends upon how far ahead are the earnings getting discounted. So this main thesis that I want to play out, and to make you understand, and especially to newer investors out there, is that don't correlate company earnings performance to stock performance. I mean, at least in the short and medium term. In the very long term, I'm sure there is some correlation, but then stocks can do things where which may be not be related at all to earnings patterns. That is the key, and because when there's a bull market, a lot of price earning expansion also takes place. So even at the same earnings, the stock price may go double, triple, right? Because the PE has expanded to that extent, or more liquidity is now chasing that stock for whatever maybe the intelligence of the market. And then the same thing can come down, even though earnings may be rising in that phase. So it is very difficult to correlate how stocks are moving versus how earnings are moving, because you really don't know how much has the market discounted at each point of time. So more examples. So this is the sort of the Kotak example where you know uh, stock is sort of going up dramatically in 1 year, comes off in the next 1 year, and stays flat in the next 3 years, whereas earnings is growing reasonably stably at 20 odd percent. So 20 odd percent growth is happening here, but stock performance is all over the place. Another one is maybe Hindustan Levers. There has been zero gains in Hindustan Levers since 2020. So, I mean, this is again a classic case where this leg up 2017 to 2020 possibly discounted almost the entire decade ahead, because people are so sure that Hindustan Levers will continue to deliver earnings that they have, brought the future valuation into today's valuation. So present value has gone up so much that, you know, for today's earning, it is not justifiable, but maybe 5 years hence it will become justifiable. So investors who come late to the party are at risk that the stock price may have to stagnate to catch up, so that earnings can catch up to that acceptable valuation in the markets, and so on and so forth. So the while we're talking about valuation and earnings, which of course we don't really pay any attention to, but the flow of funds towards a stock or out of the stock is also based on the mass psychology, that whether more should go towards the stock or not. Obviously, at some points of time, every stock may become overvalued or undervalued by a large margin, and by just watching the flow of money towards that stock or out of, you will be able to catch trend. So this is the trend you wanted to catch, this is the trend you did not want to catch. So flow of money, if you were watching the BBC principle in this phase, you would have entered somewhere here, maybe exited somewhere here, and never really gone long in this, or even if you did go long at some points of time, you would have exited very quickly. So that's how you tend to sort of evaluate the price move, not worrying about earnings. Again, in the same case here also, the profitability of Hindustan Levers has been going up very nicely from 4,000 crores to almost 10,000 crores now. So at each point of time, it would have felt that the company is doing great, let's buy this stock. At each point of time, you would have felt that. But for the last 5, 6 years, despite the profits almost going 30, 40% up, there is no change in the price. Asian Paints is another one where the previous run in the last decade has discounted I don't know how many years ahead. There has been zero gains in the last 4 years now on this. And as the company is going along, the earnings are catching up, the stock price is stabilizing there, and you really can't say what will be that point where the stock continues to then outperform and discount the next 10 years worth of earnings. So this this TINA factor, that there is no alternate to all these super quality stocks, or the BAP concept, that buy at any price, This works for very, very long-term investors. Most investors don't have the patience to wait 5 years, 7 years for that stock to perform. And in this disruptive world that we had, and like in the case of Asian Paints, so many new players have jumped in, and larger groups at that. So Birla has jumped in, Jindals have jumped in. You don't know what a kind of landscape that may happen in 5 years. Maybe they will be able to, get significant market share in that much time. And then by the time your stock price is looking good versus earnings, you may realize that the earnings itself may peter out, or the growth may have petered out by that time. Berger Paints is another such case where we've had zero gains since 2020. Now, just imagine, even if you were to say that these companies are the one of the best companies out there, and one wants to remain invested, but just see that in the last 4 5 years, had you moved your money elsewhere, you would have doubled or tripled your money. You can always come back to the stock, right? You don't have to stay invested at all times in one stock. This is not like marriage. You have to think differently when it comes to stock. You have to think it like a business, any business unit. And if, yeah, if you have, let's say, 20 stocks in your portfolio, think of it like you are running 20 businesses. Any business that is not running well, and the advantage to the investor is that you can shut and open a business instantly. I can shut down the paint business and buy an auto business. I can shut down the auto business and buy an IT company today. That is the huge advantage to retail investors. Especially, this advantage is not there to promoters. This advantage is probably not there to very large investors also, because moving in and moving out is very difficult. So this advantage that we have, that we can hop from one stock to the other, one sector to the other, and avoid the cyclicality of each of these sectors or stocks, is the sort of flexibility that we have. Again, you can see Berger Paints is growing very nicely. There is no doubt about its growth. But how much of its growth is built in already? How much will it grow in the future? How much discounting will it happen at a different point of time? Again, I come back to ITC case also. It was almost flat for almost 8 years. Anybody who entered the stock after 2013-14, by 2023 they were frustrated like hell. You're getting some dividend, but only very, very strong willed investors really were able to last this. Otherwise, whoever got their price, they got out. That, let me get out of this. I got my price back. I wasted 7 years, but let me get out of it. Growth has been phenomenal, just despite the COVID dip was there. Otherwise, we've grown from 9,000 crores to 20,000 crores. So again, the question that you can ask yourself is that, even if you're doing buy and hold of top quality stocks, that top quality belongs to today. 5 years later, will that industry be disrupted? Will that player be disrupted? Will there be different technology disruption happening there? Will there be a market disruption due to some other distribution, tactic of some other player? You don't know. It's a very, very dynamic world. To assume that, okay, I will buy a good company because the earnings is very low versus the price today, but I'm sure 5 years later they will start performing. They will keep performing. So my CAGR over 10 years will be okay, because first 5 years it will be zero, and next 5 years they will catch up. That kind of guesswork can work sometimes, but it may not work all the time, and it will give you a lot of heartburn if it doesn't work your way. So it is always best to do things where things are happening in front of you. If a stock is moving up, you buy that stock. It is moving in front of you. If it starts to fall down, you get out of it. You don't have to double guess. You don't have to be anxious. You don't have to be losing sleep. You don't have to be in a situation where your portfolio is 50% down and you are hoping that maybe it goes up again. So don't base your earnings on past data. The market is all about future, and how it is guessing the future will be there for that company or that stock. That is the whole message. Thank you so much for watching these videos. Do share these videos with your friends and family. Anybody who gains some knowledge out of this is the sort of the purpose solved for making these videos. Thanks. Bye.